As we all know, Warren Buffett is one of the most successful and respected investors and businessmen in the world. He began his path as an investor at the young age of 11 and, since then, operating in the financial market, he managed to achieve a fortune of more than $130 billion. Warren Buffett is ranked 6th among the richest people in the world, surpassed only by Larry Ellison, Mark Zuckerberg, Jeff Bezos, Elon Musk, and Bernard Arnault. Although he has a lot of money, he lives a very modest lifestyle. This is striking, because we might expect someone with more than $130 billion in wealth to live in luxury, in a large mansion, and drive expensive cars. Yet Warren Buffett chooses to live in a house he bought for $31,000 in 1958, uses a regular car instead of a private jet, and prefers simple hobbies like playing bridge rather than hosting expensive parties. But why would someone so rich have such a simple life? The answer lies in the habits and rules that Buffett has maintained over the years. Since he was little, he had an entrepreneurial spirit, selling newspapers and other products door to door. This business mentality allowed him to generate income from a very young age and thus prepare for the future. Warren Buffett is president of Berkshire Hathaway, a company that invests in other companies in different industries such as technology, railroads, energy, food, real estate, and financial services, among others. Of all the investments made by Berkshire Hathaway, approximately 40% are in Apple, 10.7% in Bank of America, 9.7% in American Express, and 6.7% in Coca-Cola. The rest is in many others. By June 2024, Berkshire Hathaway's stock market value had exceeded $886 billion. Warren Buffett's empire was not built overnight, but was the result of a lot of effort, dedication, and, above all, following his own rules. This is why it matters. Before understanding that our daily actions can have a big impact on our long-term finances. A couple of years ago, the legendary investor announced 3 rules to operate the financial market correctly. These rules are so easy to understand and apply that you could improve your financial situation significantly and build your own empire. By the time Warren Buffett was 19, he had read every investment book in the public library. He devoured them, literally, because the subject fascinated him. However, he had no set plan on how to invest. He kept searching for the magic secret, hoping that small changes on a chart would tell him where a stock's price would go. But all that changed in 1949. What exactly happened? Well, it turns out that Buffett came across a book that really changed his life, The Intelligent Investor by Benjamin Graham. Until that moment, he had never heard of Graham. This book had 2 chapters in particular that were crucial to its success. Those chapters laid the foundation for everything that would come later in his investing career. Buffett says there are 3 basic rules he learned from those 2 chapters, and they are so fundamental and simple that it's hard to believe they could be so important. But just as the 10 Commandments are simple, so are these rules. Let's see what these 3 rules are, then. The first rule is to understand that a share represents a part of the company. In simple terms, every time you are buying a stock, remember that you are buying a little piece of a company. That is, it is just an asset that you add to your investment portfolio. You are buying a small piece of the business itself. It is not just the symbol or ticker that you see in the broker. For Warren Buffett, it is not about just clicking and that's it, but about really understanding what an action represents. To understand this better, let's look at how the theoretical price of a stock is calculated. Suppose there is a company worth $100 million and has 1 million shares available to purchase. If you divide the total value of the company, or 100 million, by the number of shares, which is 1 million, you get that each share is worth $100. Sooner or later, the real trading value on the stock market will have to reach this number and even exceed it. This is the basic principle of what is known as fundamental analysis, a technique used to evaluate the intrinsic value of a company and its shares, examining economic and financial factors, and not only paying attention to the price movement on the charts. In simple terms, it's like doing a thorough review of a company to understand its financial health and future growth potential. And this is precisely what Warren Buffett tells us we should do. You must look at what type of company you are buying. When Warren Buffett was 11 or 12 years old, he knew all the symbols of the companies listed on the New York Stock Exchange. He knew, for example, that X was the symbol for United States Steel Corporation and that T was that of AT&T. But this knowledge didn't help him much because he didn't know anything about the companies behind those symbols. He only knew the symbols. He didn't understand what those companies did, how they made money, or if they were good investments. Buffett realized he had to change his approach. Instead of memorizing symbols, he began learning more about the companies themselves. He read about their products, their business strategies, their competitors, and their management team. So how do you evaluate a company? To evaluate a company, first consider its financial situation. Is it generating profits? It is growing? Do you have manageable debt? But don't just stop at this information, also look at the competition. How does it compare to other companies in its sector? Does it have competitive advantages, and is it innovating? Finally, analyze the management team, that is, those who manage the future of the company. Who makes the decisions and what is their history? Are they competent and experienced in their management? These simple questions will help you know the potential of a company before investing. According to Warren Buffett, all of this is much more important than just the stock price. Now that we know how Warren thinks, we can understand when he said, "Price is what you pay, value is what you get." So Warren Buffett's first rule is that a stock is a part of a company. Don't be fooled by the symbols and abbreviations you see on online brokers. Instead, focus on understanding the company you are buying. Before continuing with Buffett's rules, if you find this information useful, I invite you to give it a like and subscribe to the channel to stay up to date with new material. Let's move forward. The second rule is don't overreact to stock market fluctuations. Graham teaches in his book how you should react to the ups and downs of the stock market. He introduces Mr. Market in Chapter 8, and according to Warren Buffett, no one has explained better how you should behave in the face of changes in stock prices. So that you understand it better, in this book, Mr. Market is a guy who appears every day at your house to tell you how much he would pay for your shares or how much he would charge you to sell to you. This character is incredibly helpful, and he always gives you a different price. Graham wants you to understand that you don't have to listen to Mr. Market unless he suits you. This guy is like a manic depressive alcoholic who always gives you crazy prices. You don't need to worry about what he says every day. He just waits for a day when he is depressed or euphoric to take advantage of a good buying or selling opportunity. You can observe that some stocks in the financial market can reduce their price even to half of their value and then rise again. Just as happened with Spotify when its shares were trading around $200 at the beginning of 2022 and then fell 50% and increased again in 2023. This does not happen with land or properties whose values do not change so much from one year to the next. What Buffett tries to explain to us is that the stock market is unique in terms of the opportunities it offers us. That is, with stocks, you can see huge differences in prices from year to year, and that has nothing to do with changes in the actual value of the company, but with the emotions and reactions of the market. He doesn't use the stock market as a guide. Instead, use it to your advantage when you see an opportunity. Our objective is to interpret very well when it is the right time to buy and simply wait for the share price to rise. Many people have strong feelings toward their actions, but actions have no feelings toward you. They are just pieces of a company. Wall Street and financial magazines tell you about price targets, but they rarely explain how to evaluate a company over the long term. According to Warren Buffett, we should think like horse racing. To bet some money, the first thing you would do is look at each horse's history and try to calculate each horse's odds of winning the race. You don't look at the bets first, but instead analyze past performance. The stock market works in a similar way. First, analyze the company's performance and characteristics without looking at its stock price. This will allow you to make a more objective evaluation. Therefore, the key is not to get carried away by the day-to-day emotions of the market and take advantage of opportunities to sell or buy when prices become unreasonably low or high. And the third rule is to use a safety margin. Let's break this down with a simple example. Imagine that you arrive at a bridge and see a sign that says maximum weight, 10,000 kilograms. If you were driving a truck that weighs 9,800 kilograms, would you risk crossing that bridge? Probably not, right? You'll look for another bridge because you don't want to risk it falling while you're crossing it. The reason for this is that no one knows for sure how much the bridge can hold, especially if the sign has been there for a few years. The bridge may not be in as good condition as it once was. Therefore, you should always leave a margin of safety, an extra space to ensure that you are not taking an unnecessary risk. In the world of investing, this concept is just as important. The margin of safety means that you should not take too much risk with your investments. Instead, you wait to find a stock that's so obvious and so cheap that it's almost impossible not to buy it. For example, imagine you find a share of a company worth $100, but for some reason it is trading at $50. This may be due to a misunderstanding in the market, an overreaction to bad news, or any other reason. But if you've done your homework and you're sure the company is really worth that $100, then that price difference, $50, is your margin of safety. In other words, you are buying something at half the price, which reduces your risk. It's like finding a stable bridge that is definitely not going to fall when you cross it. With these 3 rules as a basis, you can build different investment strategies. It's like the foundation of a building. If you keep it in mind and apply it like an intelligent investor, you can make a great fortune. If you remove one of these rules, the building collapses. According to Warren Buffett, the ideal is to look for businesses that have something that makes them unique and difficult to copy, something that gives them a lasting advantage. You shouldn't buy a Burger King franchise just because there isn't another one nearby. You know that in a short time, others like McDonald's or Subway may arrive and compete. It's not just about who makes the most money now, but who has something that others can't easily copy. In the business world, there is always someone wanting to take your position from you. There are many ways to have this so-called competitive advantage. It can be a patent that protects the product, a unique location, or simply creating something in people's minds, like the Coca-Cola brand. Everyone knows Coca-Cola and usually associates it with a moment of happiness. In fact, this has always been their advertising motto. Even if other companies dedicated to selling beverages decided to spend millions of dollars on advertising, they would not achieve the same because people already have a very positive brand image of Coca-Cola. Anyway, there are thousands of companies listed on the stock market, but you don't have to invest in all of them. You just need to find some good ones. In fact, just by having 5 good investment ideas in your life, you can become very rich. It is better to focus on a few good opportunities than on many ordinary opportunities, but always keeping in mind the 3 rules we have mentioned. What do you think of Warren Buffett's rules? Do you know others that we should take into account? Leave us your answer in the comments. Well, that was all for today. If you found this content useful, don't forget to leave a like and subscribe to the channel to watch the following videos.